Hi there, everyone. Welcome to today's Investor Education Series. I'm Kat Delgadillo, here to co-host our event with our CEO, Hall Martin, who is going to tell you a little bit more about 10 Capital and what we do here as a company. Hall?
Great. Thanks, Kat. I want to thank everybody for joining us for another great round of presenters today. We'll also have an education session on how to invest in life science. But before we do that, let's talk more about 10 Capital. Next slide, please. So for those who are not familiar, 10 Capital was originally called Texas Entrepreneurs Network. We changed the name to 10 Capital. We went national about 7 years ago, and we work around the country. And at heart, what we do is we help startups raise funding. We provide fundraise strategy. We provide pitch deck improvements, analytics on their pitch and presentation and deal. We also provide due diligence reports. In short, we provide the legwork, saving you time and money. With that, let's go to the next slide. We also help investors. We help high net worth VC funds and angel groups. For angel groups, we are forming capital by helping them find members. We help VC funds find limited partners, primarily family offices, and we help high net worth start family offices, and they fund emerging managers. So we're forming capital for the startup ecosystem is what we do at a higher level. Next slide. We have 4 online events that we run each month. The one we're in right now is the investor education session. Each of our companies get 10 minutes to pitch, 5-minute Q&A, and then we have an investor topic. Today's topic is on investing in life science. We also have Family Office Roundtable. This is for our family offices. We bring in topics and speakers relevant to the family office world. We see a lot of people in the 25 to $50 million AUM category looking to start and run a family office, primarily online, virtual, and we're bringing in tools and technologies that can facilitate that. We also have a quick pitch. This is for tech companies. Again, 10 minutes pitch, 5-minute Q&A. We have companies pitching to a panel of investors and investors in the audience. And finally, we have the Life Science Syndicate event. This is for life science companies, biotech and medical devices that we are putting in there. If you want to learn more about our events, go to 10capital.group. That's our website, and click on the events button, and you'll see all the events that we have coming up. Next slide. If you're a startup and you want to join the people that are pitching today on our panel, take a picture of that QR code and we'll have a discussion to see if your deal is a fit for this program and if this program can be a benefit to you. Just fill out that form and let us know, and we'll be back in touch shortly about next steps. Next slide. We also have a program called Investor Connect, in which we've interviewed over 850 angel VCs, family offices, and other investor types that have funded startups to talk about how they invest, what they invest, and where they invest. And with that, we've been taking all that information and put it inside the chat bot which we call Ava. We also have the Startup Funding Espresso. That's a 300-word micro blog post on a topic related to startup funding and investing, and the time it takes to drink an espresso. You can learn something about startup funding and investing. We have over 2,000 of those and on our way to 2,500 here in a few weeks. And so we continue to build those, and to make them accessible, we put them inside an AI chatbot. Let's hear the video to learn more about how it works and how to use it.
Hi there. I'd like to introduce myself. My name is Ava, your personal AI venture assistant. I'm your new best friend in the world of investing in startups, the 10 Capital AI chatbot. I'm here to make your journey through the startup ecosystem easier, faster, and a lot more fun. Need help finding your next big investment? Or maybe you're a founder looking for fundraising tips? I've got you covered. I pull all my knowledge from over 500 blogs, countless podcasts, and even some nifty calculators, like the How Fundable Is Your Startup tool, to give you the answers you need. So how do I work? Easy. You simply go to where I live on startupfundingespresso.com and look for me in the bottom right. As soon as I appear, go ahead and click on me to let me know you're here. And then there you go. All your questions answered at your fingertips. Whether you're into health tech, biotech, life sciences, or any of the other exciting fields out there, I'm equipped to help you navigate the trends, challenges, and opportunities in each one. Got a question? Just ask. And guess what? I even pull insights from the 10 Capital Network podcast on Investor Connect. It's packed with expert advice, success stories, and more, all designed to help you succeed in the venture capital world. So what are you waiting for? Let's chat. I'm here 24/7 to help you find the right answers, connect with great opportunities, and make the most out of your investments. See you on startupfundingespresso.com.
Great. And with that, let's go ahead and kick into our first presenter today. We have with us at Doppel, Lisa Marino. Lisa, if you could go ahead and launch your slides and kick off. As we said before, each one will have 10 minutes to pitch, 5 minutes of Q&A. Those in the audience, please go ahead and put your questions in the chat bot, and we'll read those out, or in the Q&A box, and we'll answer those as well. With that, go ahead, kick off, Lisa, when you're ready.
Can you hear me now?
Yes, we can, and we can see your
Okay, sorry about
slides.
that, you guys. Hi everyone. My name is Lisa Marino, and I am the founder and CEO of Doppel. Welcome to Doppel. We are the funding platform for what families need. Ultimately, we've turned persistent family support into a unicorn level business opportunity. So what's the problem? Did you know that it costs the average family at least $17,000 per year to raise a child? And families struggle every day just to cover the basics, such as diapers. Further, over 135,000 families in 2023 alone were pushed below the poverty line simply because of childcare costs. What's worse is at the same time families are struggling, they're also eligible for federal benefits that are not used, leaving billions in unused funds annually. This is compounded by the fact that billions in donor funds are also unallocated. At the end of the day, there's billions of dollars eligible to help families every single year that's not reaching them. And it's because the market is too fragmented and it's too confusing for families to access this money. So let's talk about, So today, crowdfunding covers some of that gap, but it's not nearly enough to cover the shortfalls that these families persistently face. So let's talk about the Doppel family platform. We're a patent pending platform that turns gifts into real life financial support. So think college savings accounts, diapers, daycare, medical bills, whatever a family actually needs. We make financial support seamless and accessible. We start with estimating the family's personalized budget, whether for birth or later in childbearing. Then our AI engine matches the family with the funding sources that are available. Ultimately, we deliver a family gap plan to that family regarding funding sources. We let them know how much we can help them cover and what's left for them and their friends and family network to support. Over time, we support families with the platform as we grow with them versus just being concentrated on a single event. Our fintech platform really has 3 pillars. First, it's a mix of the platform itself is a mix of AI, sophisticated payments processing, and proprietary data that drive our engine. In the long run, our ability to source funds from multiple places and provide accountability to donors will be our long-term competitive advantages. By integrating a customer's personal data with so many funding sources, we have a moat with inherently high switching costs should a competitor come after us. So let's talk about TAM. Between philanthropic, government, and crowdfunding platforms, there's nearly $80 billion per year in unused funds available to U.S. families, as well as donations. Our solution taps into these markets and helps these eligible families fund their basic needs with money that's already there and waiting for them. Competition, think of us as GoFundMe for persistent help for families, which necessitates us looking to multiple funding sources to support everyday needs. Crucially, we source all available government and philanthropic funds and check their eligibility for those funds. This requires a tech platform to think differently about the needs of a family versus a GoFundMe, which is much more of a singular crisis point solution. We also offer much more donor transparency than current crowdfund platforms, as well as data that we can share with donors around what families' needs were added to their system, the demographics of those families, and who else helped fund that family and for what. Now let's talk about how we make money. Like classic marketplaces, we take a percentage of transactions, both on the donor gifter side as well as on the service provider / e-commerce side. The average margin on a transaction is going to range from 10 to 15%. And in the Doppel family, the family actually never pays unless it chooses to do so.
We're gaining some great traction in New Jersey. Just 2 weeks ago, we secured a commitment letter from the New Jersey Economic Development Authority. And we're excited about our New Jersey pilot for two reasons. First is access. So we are part of the New Jersey Maternal Infant Health and Innovation Center, which gives us access to families as well as other government authorities for whom we will partner. The second is scale and demography. New Jersey has 100,000 live births per year, over 700,000 families, but it's very concentrated in terms of total miles so that we can reach a lot of families in a very concentrated manner. Second, we're getting a lot of traction with doulas and other birth partners who can bring us hundreds of families. They'll start bringing us families in the next 30 days. These birth professionals are how we access and bring on families over time. We'll also release our Starlight Interface partnership in Q3. This is going to enable us to pre-qualify families for government funding. We'll use that same engine to help pre-qualify families for philanthropic dollars as well. Let's talk about some early traction we have with early family cohorts. So families like us because we're less about stuff. So think, plastic baby tchotchkes, for lack of a better term. And we're really about funding things that are persistent everyday needs for families. We've got strong GMVs on birth wish lists as well as birthday wish lists. And families, over 50% of families are adding things that are unique to us. So services, activities, recurring purchases. These are all exclusive to Doppel. Let's talk about the team. So the three C-level execs, we've worked together for the last 13 years. We scaled a company called RockU from 15 million to 150 million over 4 years, very profitably, and we sold it in 2018. Further, I sold my last company in 2024 to the McClatchy Media Organization. McClatchy is also the leader in this round, in addition to the state of New Jersey. As a team, we're experts in product, e-commerce, tuning, and the overall mom audience. There's three key takeaways from this slide. First of all, revenue scales quickly because we take responsibility for all the GMV of a transaction. We've got a very strong mix of products, recurring purchases such as college savings accounts, diapers, etc., services and activities such as childcare, piano lessons, summer camps, because recurring purchases and subscriptions are all paid up front, we accumulate cash rapidly. Let's talk about exits. We're sensitive that angels want optionality in terms of exits, and we try to provide that. We also have a very robust audience in terms of people who might buy us. Here is just a simple example of some people that could be interesting who've been acquisitive in the past. At the end of the day, we're a very de-risked investment with incredibly asymmetric upside. We know we can get a 3 to 5x return in 3 years should we choose to exit at that point, or a unicorn level exit if the marketplace scales in the way that we hope it will. Let's talk about the ask. We're looking for 1.2 million between angels and the WeFunder round. We've already got 100K committed. This is on top of New Jersey. Terms are 7 million pre-money, 1x preferred, and you're getting seed shares. Use of funds, the majority is going to product, also customer acquisition. So think bringing on more birth professionals and service providers, as well as going after moms, right? So doing traditional digital marketing to bring families into the ecosystem. And with that, that's Doppel.
Good job, Lisa. Thanks so much for that. For those in the audience, put your questions in the chat box. My first question, Lisa, is can you tell us more about the New Jersey opportunity? Why are they putting the money in? What did they hope to get out of this?
So New Jersey has a focus on maternal and infant health in general, which is why we qualified for the program. And New Jersey is exciting because not only are they bringing money this round, which is 500K, but there's opportunities for them to match in more traditional VC rounds as well. So it's a great source of funding that scales with us as we go. So that's why they're investing in us. We find the strategic value really compelling because of the access that it gives us to families, to things like New Jersey Medicaid, and to other managed care organizations. So we can bring families on at scale, but also leverage different funding sources to help pre-qualify families for different elements in their children's journeys or in their family growth journeys. We estimate that the lifetime value or the lifetime revenue of any given family, given the various funding needs that they have, is well over $50,000. Their net revenue to us is going to be 8 to 10K per family, assuming that they stick with us because we've created a solution that allows for them to scale with us over time.
And how many families are we talking about? You have hospitals, doulas, and other channels to that market, as well as New Jersey. What number of families are you looking to bring on in the next first 2 or 3 years?
So we start getting very, very cash flow positive when we've gone through about 2,000 births. So at that point, which is a very small fraction of what New Jersey live births are per year. And that's just limiting things to New Jersey. Obviously, there's about 3.5 million live births in the US per year. So we become very profitable when we're processing just a fraction or a very small amount of families each year. But as we add additional funding sources, I think we become very compelling for both the service providers, right? Because we're a way to get their service funded. And because we're partnering with service providers to bring us families, they'll be inclined to put all their clients on the Doppel solution rather than just a percentage of them.
And what kind of margins are we talking about?
Well, since we're taking transaction fees, we're looking at margins of 10 to 15%, but all that drops to the bottom line, right? This tech is incredibly scalable. And so if you've got an average birth needs list that's $3,000 to $4,000 and you're picking up, 10 to 15%, that's $300 to $500 per family coming through the system. And that's just having a baby. Over time, as they do the first birthday and the second birthday and have needs that are more persistent. For example, you're going to need childcare until your kid goes to school. They continue to come back to us and we continue to help them fund those needs.
How long do you anticipate them staying in the program year after year? Is it, fifth grade, sixth grade, ninth grade, college? How long do you think they may be there?
Well, I think we get a lot of families, given our ability to provide persistent support until the kids are out of the house.
18 years is what you're saying, something like
Yeah.
that.
Yeah.
Wow. Okay. And what are the ways you're going to monetize that?
Well, so as families come up with needs over time, right? Let's say childcare. You're going to need childcare until maybe your kids are 10 years old. Well, that is the single most punitive expense in any given family. And so if we can cut that in half, we're monetizing every transaction and we're reducing how much money the family's coming out of pocket and we're moving it to the village. And so that creates a very sticky platform and a very sticky experience for any family who has who is challenged in terms of funding their monthly needs.
Right. Well, your primary competitor is GoFundMe. What's your competitive advantage against them? What's your leverage?
So I think I think there's three different places where we differentiate ourselves. The first one is we handle the persistent needs of families, whereas GoFundMe is awesome in a crisis, and while these families are often in constant crisis, you don't build a GoFundMe for everyday solutions. So I think that's one. Two, our tech and our data. We provide a level of transparency for donors that does not exist in the GoFundMe world. So let's say you're the Gates Foundation and you gave us $1 million grant. We can tell you how many months of diapers for families were delivered. We can let you know the demography or the demographics of those families, the household incomes of those families. We can let you know who else helped fund that family for very different needs. Maybe somebody's contributing to childcare, but you're doing diapers, right? And so what's the big picture of what's happening with the family? Last, more money, because we're a very scalable platform, goes to the people in need rather than supporting the infrastructure of a traditional not-for-profit.
Well, tell us more about the team. What's the track record there?
So we've been together for a long time. I personally have had 3 exits throughout my career, and we all exited at RockU together in 2018. Um, in terms of our expertise, Josh is great at product. Emily really understands the mom space incredibly well, as do I. And I'm much more on the, the BD and the marketing side and figuring out the strategy and the relationships we need to propel us forward.
Great. And that's our 15 minutes. Thank you so much.
All right.
Next up is BioVent. Mark, if you can launch and load your slides, kick off when you're ready.
Excellent. Thanks, man. Can you hear me okay?
Yes, we can.
All right. And can you see my screen now?
Coming up, there it is. You're good to go.
All right. Great. I'm going to go ahead and move this poll out of the way here. There we go. Wonderful. So good morning, good afternoon, good evening, everyone. Thanks for your time today. We are BioVent. We're bringing to market a simple, fast, portable microbe detection platform for use in the oil and gas industry. There is nothing sexy or flashy about detecting microbes that cause corrosion, oil and gas pipelines and storage tanks, but it is a huge real-world problem. There are more than 100 leaks every year, and that means that there is a harmful oil or gas release in America basically every 3 days. So the industry knows it's a problem. They've spent years investigating it to determine that between 20 and 40% of those leaks are actually caused by corrosion that's been induced by bacteria. It's become a well-known problem in the industry, and billions are now spent on it every year to mitigate the potential for that damage. The challenge is that the current approach to identifying corrosion in oil and gas areas is the operators take samples, either monthly or weekly, from different areas of their facilities, and then they laboriously prepare the samples for transport by wrapping them up and packaging them in coolers and shipping them to off-site centralized laboratories for testing. Those tests take anywhere from 2 weeks to a month to produce results, confirming which bacteria are actually inducing corrosion in their system. And during that delay, the owner and operators have very little choice but to implement some sort of preemptive biocide treatment that usually costs them tens of thousands of dollars. Then, after the lab results are finally received, they analyze them retroactively to understand whether they made the right treatment choice or not, and determine how they should modify their treatment plan, whether to execute another costly treatment application. We'll then take more samples and wait for more results, and the cycle continues. But with BioVent, our technology allows them to turn that 30 days into just 30 minutes. Using our rapid results, they can craft their treatment plan the same day and initiate targeted applications in real time with current data, knowing which microbes are actually in their system causing the corrosion. So by cutting down that time frame from weeks to a single day, they save time, they save money, and they're increasing their ability to target specific destructive species within their systems using the right biocides and the right application schedule to mitigate the risk of corrosion and damage to their facilities. So how's the technology work? Well, we have exclusive license for a patented technology that was developed over several years by a federally funded laboratory that addresses these market pain points right at their source. Using isothermonucleic acid amplification, our system provides the same level of sensitivity and specificity as a traditional centralized lab, but we do it with a handheld system that accurately identifies the presence of up to 18 target microbes from a single sample on site in 30 minutes at a price point below our competitors without the need for highly specialized training. So most operators have been using culture-based testing for years, so the challenges are pretty well known to them. Many operators actually adopted ATP testing about 10 years ago, but that really only tells you the total number of bacteria, not what good bugs or bad bugs are actually in there. And then finally, our third classification of competitors, that qPCR, that's what they use in those centralized labs. It is as accurate as we are, but it is slow and is expensive, and it requires really highly trained scientists to accurately produce usable results. We can provide our solution to our customers in a simple and effective ratio model, right? Buy the base station instrument at a reasonable price. We make significant revenues from these single-use disposable cartridges. Our customers are excited because they save money on the instrument, they save money on the tests, they save time when they get the results so quickly, and they can see the improvement in their process immediately. And then looking at the future revenue streams, as we enable more rapid, low-cost testing, the volume of data available to the industry increases. So then we can start looking at, hey, this is where MIC occurs and when MIC occurs. And it allows us to begin building up an understanding of how we can predict corrosion and then package that information into a revenue stream so they can actually proactively prevent corrosion within their pipelines. So here's what the market looks like. Focusing on just our primary adopters in Houston, LA, San Diego, San Francisco, we see more than $80 million in annual revenues. The market for us is attainable because we're actually getting a strong foothold in the oil and gas market already through proving ourselves with our current on-site work, with the highly influential folks at the nation's largest gas utility, and we can tell you that it is SoCalGas, and Hess, a leading independent energy company with global operations, as well as building our relationship with our seasoned corrosion specialist who has reached throughout the target market. We arrived at these numbers, by the way, based on customer research and on-site discussions that show that each one of the users will require an average about 25 cartridges per month for their testing during the first year as they integrate us into their current process. And that subsequent need expands to 63 cartridges per month for the life of the device. We have two sales pipelines that we're building right now. First is the oil and gas extraction, distribution, processing companies. You know these guys, they're Exxon, Chevron, Kinder Morgan. We're also with those third-party asset integrity providers who provide the maintenance and repairs on those pipelines and storage tanks. That's the Schlumberger, Halliburton's, the Baker Hughes, who actually, we just last week got a request from them to do a proposal for a pilot test at their facilities. For these kinds of customers, our CAC is $6,600, but our lifetime value of a typical customer is $26,000. So sounds great, right? But let's be clear about how we got to this inflection point, because it didn't happen overnight and it wasn't easy. Back in 2022, we got our hands on the technology that had been developed and tested over several years at Lawrence Livermore National Lab, which is one of America's top national labs. And then they finally patented it. We worked to determine if the technology could reliably produce the results necessary to be commercialized successfully. And at that point, we partnered with Enhancco. Tom is out there. He's an oil and gas corrosion service provider. He's been doing this for 40 years. He knows everybody in the sector. He saw what we were doing and immediately committed $160,000 of in-kind support for testing out our technology. Then through a competitive process, we were awarded a $1 million grant from the California Energy Commission, $999,970 actually. And then that will allow us to refine the technology and then produce a functional kit. We secured an exclusive license on the technology and then secured an agreement with SoCalGas, the nation's largest gas utility, to test a solution in their live system, who then also provided us cash and in-kind funding as well. So we are literally in the field with the corrosion teams, pulling samples, gathering firsthand practical insight to how our technology fits into their existing operations. We've opened our labs in San Diego to produce the assays for the first oil and gas targeted cartridge. We developed and tested and validated 2 of the 18 assays. We have 6 more in the further stages of development right now. And they accurately identify MIC microbes found in oil and gas pipelines using the samples that we had taken from those on-site testing. And we completed our first on-site hardware test at our Alpha Partner facility. And then we just finished building our most recent handheld functional unit to take into the field at the end of June to do our actual on-site pilot testing. That pilot test, by the way, breaking news, the CEC is going to be out there with us. They are so excited to see the technology in person. They're sending one of their people out to be on site with us at SoCalGas just so they can see it work. So it's an exciting month for us. So this is where you come in, right? The opportunity in our ask of you is to support the additional assay development, the customer-driven enhancements to the base station, and our pilot demonstration with SoCalGas and with Hess, the leading independent energy company with global operations. So we have the technology, we have the core team, we have the network, and with your support, we deliver a game-changing technology to an industry that's so in need of our product. They've already committed more than $1 million in non-dilutive cash just for the chance to have our technology tested in their facility. But you know, and I know, the success doesn't just happen. It takes people, it takes the right people to continue the trajectory and continue the momentum that we've built to date. So we have a balanced team of technical, scientific, financial, and entrepreneurial talent with industry network, academic credentials, and real-world experience to continue to build on the early success of this company and accomplish this mission. We have a known problem in the industry. We have a solution ready to go and being tested in the field right now. This first market is large and getting bigger by the day, and we have the momentum to carry this through to commercialization and profitability. This is a significant opportunity to solve a critical problem for the oil and gas industry. We have the technology, we have the traction, and we have the team to do it. And I'd love to take your questions this time.
Great. The first question is, how scalable is the technology?
As much as you want, right? I mean, we've got the cartridges do 18 assays right now, but we can customize the cartridge. You can see it right here. So each one of these is a different assay that identifies a different bacteria, microbe, or virus. So we can actually customize these cartridges to the needs of the customer. We do NGS testing on site with them. We identify what are the 18 most impactful microbes that are causing corrosion in your system, and we can provide them a custom cartridge. Or we provide them a common cartridge, and they can go and they can test anywhere they need to. It also, by the way, I think we've got our next slide here. It doesn't matter what industry, whether we're talking about animals, pathogens in animals, or humans or industrial sites. All we have to do is build the assay and update the individual assay itself to target that DNA, and then we can identify whatever is in that sample.
Great. Next question is, what were the strategic reasons to go structuring this as a safe round instead of a convertible note?
Yeah, part of it is we felt that we had really good traction. We felt that what we wanted was investors who believed in this position, who understood the market, who understood oil and gas, who looked at us and worked with us and said, yep, these are the ones to do it. And we want to take the time to really lay that foundation strong because we have such larger markets coming on. We didn't want to have to try and bail out with some cash later on. We wanted to continue to build and build and build and build because this really becomes a strong, strong opportunity.
Great. And then on the business model side, what's your margins on the product?
Sure. We're in the 60 to 80%, depending upon how much we can scale right now. Both on the actual base station itself and on the cartridge. But of course, we sell a whole lot more of the cartridge.
There are many pipelines out there. What's your ideal customer profile? What segment of the market are you going after, and how many structures are in that segment?
Yeah, so I got 831 that I'm targeting right now. These kinds of facilities, and what you're looking at is both from a pipeline standpoint, because it's anywhere that you can take a sample, right? So whether you're pulling a coupon, whether you're doing a fluid sample from a storage tank, anywhere there's water, that's where we're actually going to be testing. We've also had interest from folks who are doing failure analysis. When you get on site, you pull that pipe out and they cut the pipe open, immediately doing the swab there. So we're talking to Colonial Pipeline out here on the East Coast. Next time they have a failure, I get to drive out and just swab that puppy to see whether or not they've got microbes that caused that failure. The reason it's a big deal right now is from Aliso Canyon. SoCalGas had a huge release that cost them $1 billion in fines and $1 billion in remediation. And it was a methanogen, which you can't culture those, so it doesn't work on the bug bottles. You can only do the DNA on it. So our ideal is these 183 that we've identified, both gas pipelines and gas storage tanks.
What's the regulatory environment here? What regulatory do you have to pass to get into this market? What barrier of entry is that?
So one of the reasons we chose oil and gas is because I don't have to be regulated in any way, but these are highly regulated folks. And what they need is a test that they can show and they can prove is the same as the sensitivity and specificity of what they're currently using. So what we have is the data to show that we are better, stronger, and faster than bug bottles. We are better, stronger, and faster than ATP. And we are at the same level of sensitivity and specificity, but faster, lower cost, and just as accurate as those PCR tests.
Is there any regulatory around mandating certain tests or approvals or requirements that the oil and gas people have to adhere to?
No, not that we know of or that they have raised with us yet. They are highly motivated to avoid fines. They're also highly motivated to avoid negative press. It was a huge problem when they released all that natural gas in Aliso Canyon.
Great.
So, yeah.
And who are your partners with you in this? Who are you working with to get into this market?
So right now, we have the California Energy Commission backing us. We have Southern California Gas, who is allowing us that on site. We have Hess, who has just come on to allow us to do pilot testing up with them in North Dakota. And then we have Enhancco, who is the corrosion service provider, who's the one who identified us early and said, you're the next big thing. I want in now. Let's go.
That's great. And let's see, I think we had another question over here. Okay. And so, the question we get into now is what's the key to success here? What do you have to prove in order to win the business from the client? How efficacious or non-toxic does it have to be? What do you see there as the challenge you have to overcome?
Yeah, so there's a couple of things. One is the oil and gas business is as hugely profitable and money involved as it is. It's actually a small group of folks, and they all know each other. So we were actually just out at the corrosion conference, because they have those out in Nashville, and asked basically that same question: what do you need to know from us to make sure that it works? And they said, all we're going to do is we're just going to do it side by side with everybody else. We're going to pull bug bottles. We're going to do ATP testing. We're going to do yours, and we're going to send it to the centralized lab. And as long as you match up or beat them, then you're fine. And we'll take your technology. What you don't want to do is a black box that doesn't work or that you have problems with. So that's why we're doing pilots right now and building that reputational capital. So once we have CEC back us, once SoCalGas says, yep, we use it all the time, once Hess says, yep, we do it, and once Enhancego says, man, I'm using it on everybody, that really that opens things up in a tremendous way.
And who are the next hires that are coming up with the funding? What do you need to do what roles do you need to fill in order to achieve the goals?
Yeah, specifically, I'm bringing on I'm bringing on two wet lab associates, researchers, so they can finish up the development of the 18 assays, and then they can also do the customized assays, and then one software developer who's going to do some enhancements to the software stack so that it's easier for folks out in the field. They can see the results, but they want to be able to see them on their data as well.
Okay, great. And that's our 15 minutes. Thanks so much for a great presentation. Thank you
Thanks,
guys
everybody.
for great questions. And with that, let's move to our next presenter, Print3D. Lance Thurkill, if you could launch and pitch your slides when you're ready.
Hi, I'm Lance Thurkill, co-founder of Printed Technologies. I'm a two-time founder with a previous 8-figure exit. And as you can see here from this slide, America has a real problem. We're currently short 7.3 million affordable homes. We're only building 1.4 million homes per year, of which less than 10% is focused on affordable housing. To make matters worse, construction costs are up 30% and the industry is stuck in the past. Meanwhile, people are struggling to find a place they can afford to live. At Printed Technologies, we're solving this problem by disrupting the construction industry. And we're doing that by bringing automation, AI, and 3D printing to construction to make it more affordable, sustainable, and scalable. But before I tell you how we can do that, let me tell you how we got here today. In 2021, my family unexpectedly lost their home to mold, and building the next house took twice as long and went 50% over budget. At that time, I knew there had to be a better way. Couldn't help but think, if it's this inefficient for me and expensive for me, how much more impactful is that to people that are struggling to afford a place in the first place? The reality is the system is broken. And when there is a broken system, there's an opportunity for innovation. That's why we built Printed Technologies, to solve a real market failure. Here's me and my co-founding partner, Craig Pettit, outside of one of our 3D printed homes. To give you a little history, my family's been invested with Craig in his residential real estate portfolio for over 30 years. And in 2019, he bought a 3D printing machine. And after a couple of years of retrofitting and putting it back together, he successfully printed the 7th and 8th 3D printed homes in America. As a third generation owner of a manufacturing company that is highly focused on automation, I became fascinated with this concept. And through my experience, having built several homes myself, the inefficiencies were shocking to me. Coming from manufacturing, where precision and efficiency is the foundational blocks, the starting point, the lack of these principles were just shocking to me in construction. That frustration sparked an idea. What if we could bring this manufacturing mindset, automation, robotics, AI, to disrupt the housing industry? I pitched my idea to Craig, and he loved it. We had the perfect combination of expertise, his real estate and construction background, my manufacturing experience, to tackle one of the world's largest problems, affordable housing. So in 2023, my company, All Metals Fabricating, we made our move. We invested $750,000 to match what Craig had put into that point, and we launched Printed Technologies. Our mission is simple: revolutionize construction to make it more affordable, efficient, and scalable. We're not just building homes, we're manufacturing and selling machines that will help builders everywhere embrace this new era of technology. So let's understand the opportunity. For over 100 years, American homes have been built the same way. Over 100 years. Wood framing and labor-intensive construction. Hey, it worked. It fueled the economy, it developed communities, and created the American dream. But sadly, that American dream has slipped away. So you can see here from this slide, rents have outpaced incomes for decades. Further, homes prices have more than doubled since 2000, while incomes just simply have not kept up. Also, as I mentioned, 30% construction costs have risen in the last 5 years, not including surges we're about to see from tariffs. And the industry's way of solving this problem has been to use less skilled workers and inferior materials, which just leads to a decline in the quality of housing. And it's proven that throwing more people at the problem is not working, considering the great deficit of number of homes we're building per year compared to the need of homes per year. This graph shows that in just 10 years, the amount of people being able to afford a home has dropped from 50% down to 16%. This is a massive issue. And we have a solution. I don't know if anybody's ever seen a 3D printer, probably a little desktop one. Now scale that up to the size of a house. And here you have, and as shown in the pictures, our patented 3D home printing machine. The way it works is like a soft serve ice cream dispenser, except it's dispensing concrete. And what we call G code, geometric code, tells the machine where to move and what to print. Here's some renderings of a house, one of our model homes. And here's another rendering of some model homes. This is one that we built for $100,000 last year. So what differences does our solution offer? We can provide, first off, we can provide a 20% savings for a wall system that far outperforms traditional building methods. Our walls are mold resistant, termite resistant, fire resistant, and hurricane and tornado resistant. Next, we can provide a 30% time savings versus traditional construction. Time is money. With our wall structures, you're removing masonry, framing, sheetrock, tape bed and texture, paint, and insulation. Managing trades is a big part of construction. That is the biggest pain point in construction. And we believe that we can expedite these time savings to even much greater than 30% through economies of scale. Next, reduce waste. So precision construction practices combined with the long-term durability of our product being a concrete wall, this will drastically impact the use of landfills over time. Next, operational or ownership costs. First off, our walls are more energy efficient, lowering energy bills. The walls are much more durable. So your impact on having to fix walls and do things like that, it goes down drastically, especially relevant in the build to rent space. So what is our secret sauce, our competitive advantage? It really starts with our partnership with All Metals Fabricating, which I own. It's a world-class manufacturing facility shown here in the picture. And this vertical integration gives us complete control over costs, allowing us to produce our machine for a cost basis of $175,000, with the most comparable option on the market starting out with over a $1 million sales price. Also very important, this partnership allows us to scale up as quickly as we need to in terms of the market demand for selling machines. And so there's no amount of demand that the market could create that All Metals Fabricating could not keep up with in terms of manufacturing these machines. Next, combining our real estate experience with data-driven insights and approach will allow us to streamline construction nationwide. Lastly, Printed has inherited an expertise and efficiency focused and automated approach to construction. What I mean by that is through our partnership with All Metals Fabricating, it's been a 70-year business. We've inherited this expertise that as a leading manufacturer and automation efficiency mindset that we've now inherited that as a company at Printed. So what have we accomplished? 2019, we bought our first printer. 2021, we've printed the 7th and 8th house in America. Since then, we've built 5 other structures, including a house for $100,000 in 2024. We've designed and built 2 of our 2nd generation machines. We achieved a top 10 worldwide rating for automate construction and a top 5 for 3D home printing. We developed an augmented reality app that allows users to walk through our houses virtually. We also look to leverage this technology and further develop it to train builders and trades on utilizing the technology. We renamed and rebranded and launched a marketing campaign. And then this year we received our patents back on our design. We've developed a sales pipeline with currently $2.5 million in the sales pipeline. We've invested $1.5 million to date. And recently we won 3D Printing Company of the Year by Construction Tech Review. Given all that we've accomplished, I feel very confident in raising the first million at a discounted $8 million valuation and the second tranche of $2 million at a $15 million valuation. And what we use that money is to achieve the following. Starts with developing a proprietary software that will automate the G code. So what I mean by that is allowing you to take an architectural rendering, whether that be 2D or 3D, drop that into the software and it automatically create the G code to tell the machine what to print. This will allow builders everywhere to adopt this new technology and not be dependent on creating the G code. Also important, this creates a SaaS revenue stream, which as a technology company is a critical component. Next, we're going to invest in R&D for the development of a brick print head style. So be able to print bricks as opposed to the beaded look to allow us to appeal to traditional architecture models. This will also allow us a more efficient way to achieve a smooth wall surface. We also want to develop a mini batch plant. It's about a $250,000 investment. That'll drastically reduce the cost of the materials. Currently, we're using a 3D mix. And so that's a big cost driver for us in terms of our print costs. Next, we'll hire an R&D team to support ongoing innovation so that we're not slowed by construction jobs. And then we'll build some additional machines to be able to take on large-scale development projects and also have sufficient stock for sales. Here's some very conservative numbers based on us both printing structures and selling machines. So 2025, 9 structures printed, 2 machines sold. 2026, 40 and 8. 2027, 75 and 24. And 2028, 125 and 48. Now, market adoption by builders could drastically increase this growth curve, and All Metals would have no issue with keeping up with the capacity. Plan on selling our systems for $400,000 with a cost basis of $175,000. So for example, of 2028, if we sold 100 printers, that would boost our revenue by $20 million and profit substantially as well. Now, in closing, I want you to imagine this. I want you to imagine an entire community being built by 3D printers, 10, 20, 30 printers out there, 1 to 2 guys operating each one. And then a family like this moving in after just 3 months later at an affordable price in a house that they can be proud of. And with this type of solution, we can change the trajectories of affordable housing. This is more than an investment. It's an opportunity to fix a broken system and transform the future of housing. We have the technology, the expertise, and the urgency to make homeownership more accessible while building a high-growth, scalable business. The time is massive, or the need is massive, rather, and the time is now. Join us. Thank you.
Great presentation. For those in the audience, please put your questions in the chat box. So first question is, Lance, thanks, Lance. Appreciate the work in this area that you're doing. So good kudos there. My first question is around rev shares. How much money are you getting out of selling the houses that you build versus you're selling the system that builds the houses?
The model we built was based on a $100,000 build job. So that's really in the affordable housing sector. So, the way to think about it is we can be GC just to do the wall system, which is ideally where we want to go, just doing that and selling machines. And the average job would be between $30,000 and $70,000. If we built the whole house, that could be anywhere from $100,000 to $1 million, depending on the scope of the house. And then selling machines, $400,000 with a cost basis of $175,000. And gross revenue on the print jobs is about 30% rather. And then if you're doing the whole build, it comes down to like 27% because you got the GC fee plus the 30% margin on the print.
Who do you envision buying the systems to build houses? Are these the traditional residential housing builders now, or you think it's a new category coming up? Or what are some of the names of the people you're talking to about it already?
Yeah, I think home builders, so and large development companies are our target. Currently, it's limited. Municipalities have not embraced this technology, or rather, only a handful have. So you're limited to rural areas until they can adopt guidelines from an outside entity, which is in the process. And so I don't envision many builders adopting this until they can print in cities. And I think once that happens, I think mass adoption will occur by builders.
Great. Next question comes from the audience. It says that, can you talk more about the competition, as there are a number of other 3D concrete companies out there, Rice Bag Homes, et cetera, and who are the startups that are working in this space and competing in this area?
Yeah, we've got a competitive landscape slide that I won't go all through right now. I'll give you a quick answer is the differentiator. So you've got the biggest players are Cobod, which just sells machines to builders in the very hands-off approach. And they sell about four or five machines a year. And then you have Icon, and Icon manufactures their machine and does not sell them. So they're purely construction company. And then you have a bunch of companies that either buy a Cobod, most of which buy a Cobod. And then some who have developed their, a handful of others that have coming out with their own systems. They can also buy a Cybe, 2 or 3 other of the major players. So the big differentiator for us is we're both manufacturing the machines and also building homes. And so being able to attack both, I think, is critical. You being able to know how to best run the machine and improve and enhance your machine by getting those reps in as a builder really helps differentiate us. Also, the vertical integration is huge. We've inherited a $25 million manufacturing facility by our parent company, our investor, being All Metals Fabricating. Huge differentiator.
Great. Next question is, what contract protections are in place with the vertical company you own to avoid future cram down issues once there's sufficient investment in these projects?
I'm not sure I totally understand the question, but they're asking what protection we have as All Metals Fabricating.
I believe so, yes. Once you have the houses built out there and they're growing and so forth, it seemed like there might be some price compression in there, or there might be some falling cost of the actual machines and so forth. But maybe Brandon, you give us some more more detail about that here in a
Yeah, and in the
moment.
meantime, I'll answer. I mean, so in terms of protection from All Metals, we've got insurance, and that's arm's length, investment. We're pretty well protected through our commercial liability and as an investor. And in regards to the printed being protected, that each home is insured on its own as a standalone entity. We also have commercial liability insurance, general commercial. So each structure is independently insured, and any losses would be incurred against that structure and go to the insurance company. Hopefully that answers also.
Good. That's great. And if you were looking in the chat box, there's one more question about concrete produces more carbon than using wood. If you could answer that. And if you're here for the breakout sessions, you can also answer it in that format as well. With that, let's go ahead and move to our final presenter, Combat Medical. If you could go ahead and launch your slides and show them when you're ready. Thanks for joining us, Edward.
Can you see me? Can you hear me, Hal?
Yes, we can.
Brilliant.
You
Thanks.
don't see your slides yet, though.
You can't see the slides. Oh, sharing.
I think if Lance, you could unshare and he can share. There you go, Edward. It's coming up. We see your screen and it's full screen mode now. You're good to go.
Okay. Thanks for inviting me. Hi, my name's Edward Bruce White. I'm the CEO and co-founder of Combat Medical. I've been with Combat since its inception. Combat has developed a hypothermic drug delivery platform that significantly improves clinical outcomes. And what I mean by this is we've demonstrated in phase 2 real-world registries that we're over 100% better than the best FDA-approved drugs and 50% approved than the best published data. So we're significantly better. It really does mean that. We're already selling and profitable. We've raised $20 million today, and we're looking to raise $5 million this round, of which we've got 2.7 already committed. So what's the problem? Well, there's been no innovation that's affordable, effective in the world's most expensive cancer, and that's bladder cancer. In terms of our commercial credibility, like I say, we've already actually got sales of 4.3 million and 700,000 EBITDA. We've done 100,000 procedures. We're across 35 countries, got 40 publications. We've got very strong IP that supports this, and we're the only company that's been able to effectively deliver hypothermia. And it's a platform technology. We've got 2 systems already approved with CE Mark. We've got $4 million of Innovate UK government grants, which we've developed 2 new treatments for colorectal and ovarian cancer using the platform. And importantly, what we're here to really discuss and get look for money for is to fund an FDA-approved trial. So here you see the system's working. It's a closed system. We catheterize the patient, and then we recirculate the fluid or in a closed loop for up to an hour. It's done in an outpatient setting. It's targeted, so it only affects the organs that we're able to perfuse and deliver into. There's no systemic side effects. We're enabled to give the exact temperature that is effective because of our powerful patented aluminium foil technology. We're able to very precisely control the pressure or agitate the fluid in terms of getting the fluid around the organ. And it's user-friendly. It fits in with the existing clinical practices. We're in 350 hospitals. We've used it actually in Duke University in the US, and it can be used with many drugs, 5 drugs so far. And some of the new drugs that I'm going to present that haven't actually been approved, we could actually potentially become partners with in the future. So why hypothermia? Well, cancer cells don't like heat, and they get stressed at 106 Fahrenheit, where good cells don't get stressed to 111. It activates the natural killer cells, which target the heat stressed cells, which builds a lasting immunity. It's better at killing by up to 10 times. It becomes more potent, better concentration, and improves the effectiveness of destroying the DNA. We've got a load of clinical evidence behind us because all the patients that we've been treated. So this is one paper, 174 patients. This is the FDA trial that we're going for. And if you look at the results here, you can see that we get a complete response rate at 70% at 12 months. Remember this. Another group of urologists, this time 60 patients from Cologne University, 67. So consistently getting the same results and better than everybody else. And in terms of experimental use and using outside of the standard of care, the most powerful group in the world, the International Bladder Cancer Group, now actually recommend to be able to use hypothermia once you've exhausted or a patient refuses to have their bladder out. So in terms of the competitive landscape, we've got people like Keytruda, who've got their checkpoint PD-L1 and it's done 30 billion in sales. It's been tremendous at helping other cancers. It's growing rapidly, but only a 19% complete response rate at 12 months. Pairing with nadofaragene, another FDA-approved drug, 24% month. Immunity Bio listed, got approved last April, 2 billion market cap, but only a 35% complete response rate. So you can see in terms of the trend we have here, Johnson & Johnson believe they'll be able to do 5 billion in sales by in the coming years when their drug approves, 44% complete response rate. And CG Oncology has the best results published so far, 1.8 million market cap. They listed it in 2004, 64% complete response rate. So in terms of looking from the bottom up to get a look at the serviceable market, if you look in the US, the FDA trial that we're focusing on is just 10% of the market, 10,000 patients of the 100,000 that are available. 15 treatments, that gives 150,000 treatments. At the price point that we're looking at targeting is $4,000 a patient. It's like $600 million in terms of revenue. The total addressable market is over 800,000 patients, which gives it a 9 billion market. Remember, this is just one indication that we're potentially looking at. Bladder cancer is actually the smallest of them. Colorectal has a market potential of over 2 million patients. And analysts believe the market is going to be supported by about 21 billion by 2034. We've got an FDA-approved trial and confirmed the pathway. We've had 3 meetings with the FDA, which have been led by Jonathan Jarrow. Jonathan Jarrow was the actual ex-chief medical officer that wrote the guidance for this clinical indication, so we're pretty well placed to do that. And we expect to have interim results from 2026. Remember the company CG Oncology, they listed off the back of 66 patients. We'll be listing on 75, and our results should be twice as good. And they had a market cap of 1.8 and they raised hundreds of million. And we expect FDA approval by 2029. We've got an established business model. In Europe, we just sell the device because we're a device company. In America, we're going to become a drug. So we're going to be selling the drug and the device and the cost of getting to market, which is why it's a lot more expensive in America. It's a razor blade model. We give away the system free of charge and make our money from the disposable kits. Already 90% of our revenue comes from repeat revenue today. We've got strong revenues, 80%. That'll grow to 90% in time. We've already established our manufacturing and supply chain, and we're ready for that. And we expect sales to exceed 500 million by 2034. We've got a global presence in over 35 countries. We've got a direct sales force in the UK and Spain. We've got an excellent team, both me and Alberto, my business partner. We're serial entrepreneurs. We've developed over 10 medical devices and brought them to market successfully. The team has been involved in financing deals and successful IPOs and exits. Our clinical advisory board reads like the who's who of bladder cancer and hypothermia. So the problem, there's been no effective, affordable solution. Well, now HIVEC is. We've got a problem that's really seismically changing the outcomes in patients. And we've got a lot of competition, but we're a lot better than them. And we're better in terms of price. We're better in terms of side effects and ease of use. And we've got more experience than because we've been selling in Europe for the last years in terms of treatments. All the clinical trials have done, we've actually got more experience. So in terms of what we actually have to do to become successful, we've got an FDA trial. With the results for that, we will be able to become a global standard of care because we'll get into the guidelines for Europe and the US. We need to be able to complete the funding to be able to do that. It's a $7 million trial. We need 5 million because we can contribute 2 million from our profits that we've already got. And we expect the interim results to come in 2026, at which point we see a massive value inflection point of north of $1 billion, given what the market has already supported. We've raised $20 million to date. We're looking to raise 5 million at a pre-money value of 38 million. We've got 2.7 already committed. That's for our ordinary shares. And in terms of Exits, our first exit could come potentially as soon as 27 when we actually have the results. We're already in discussions, ongoing discussions with all these guys. We're ongoing discussions specifically. Johnson & Johnson and Boston Scientific would take a close interest in us. And all our options are open, even a potential IPO, because we're a platform and other companies are doing that and the market accepts them. And also because in terms of the business, once we actually get clinical evidence for the European business, the 350 hospitals, if they were all to start just using as our largest hospital today, we would go from $4 million in sales to $30 million overnight. So potentially we can actually scale and grow the business organically from ourselves. I'll leave you on this slide and take some questions. Thank you very much for your time.
Great, thanks. First question comes from the audience. It's thanks, Edward. What's your story regarding these forms of cancer? Can you tell us about your why?
Why the cancers?
Well, why are you going after this? What's motivating you?
What's motivating me? Well, we started by trying to actually warm blood, and one day by chance we met a doctor, and he was incredibly passionate, and he persuaded us to try and make a system, and we could see that it could make such a tremendous difference. And as he was telling us about bladder cancer in terms of how expensive it was to treat, and patients just kept on coming back again and again and again, it struck us as an amazing opportunity to be able to make a tremendous difference, but also, in terms of actually a good business opportunity. And we had a uniqueness in terms of our ability to be able to warm fluid very accurately.
Okay, great. So you're currently selling this outside the US right now, making good money with it, and now you're going through FDA for the US market. What is the FDA challenges in front of you there? What do you have to prove or clear before we can actually get to market?
So the FDA level is a 3-month complete response rate. So it's before the end of the trial. The end of the trial looks at actually a 24-month follow-up. And so we have to get to 3-month complete response rate and show a durable response. The actual lowest level the trial approved at the moment is a device of 30% complete response rate. Our complete response rate at 3 months is 93%. So in terms of getting FDA approval, apart from the FDA issues in terms of the US situation at the moment, we believe that we're going to have the best device. We're doing everything according to the FDA requirements. We've got the ex-FDA Chief Medical Officer, the person that used to review trials within this section, who's actually advising us on the trial. So we believe that's what it is. Clinical efficacy is what you need, because you need to be able to convert the market. Lots of these drugs haven't had traction because they're just simply not good enough. They've got nasty systemic side effects, and they're very expensive. And so we hope to be able to change that trend, because we know we're easily deliver, we don't have side effects, and most importantly, we'll have a clinically meaningful outcome in terms of we have to be north of 50% at 1 year.
Great. And what size populations do you need to put through these clinical trials? How many patients?
The clinical trial is 238 patients. It's broken into 2 different types of cancer. The FDA are interested in one called BCG unresponsive for CIS, which is a cancer that hides underneath the surface. That's 123 of the 238 patients. And we've got a report on 75 patients, which is why we've chosen that number. And we've gone to a bigger number because we want to be north of 100 patients for them to be able to review the data.
Well, there's many potential exits. What is the most likely exit you think you'll encounter?
I honestly think, in terms of, because it's disruptive, that we could sell the bladder business. And if we were to sell the bladder business, then we'll be able to offer an exit of most probably at minimum 10, but 25 times return on X in terms of the investment. We'd be able to keep back the money to be able to then complete the rest of the platform. My preferred option is using the data, using the clinical data, building the business, taking on debt so we don't have to dilute our investors, and being able to offer some liquidity as we go, because the business will be profitable and people will be able to create that and create a market. So we've had some investors that have been with us for a number of years now, so they can get their return and get an exit. An IPO is a real option because we could become a massive global company, and I've gone through that process. I was involved in the Large Mask company, and I managed their IPO 330 million listing. It's just very arduous, and I think for innovators like us, it's much better to remain private, and we'll extract much more value, offer more value and return for our investors.
Okay. Next question is, I have a stepbrother being treated for bladder cancer now in clinical trials in USA, especially in Northern California.
We're not in the US, so we can't really help in terms of treatment. It is possible to go and get treatment in Europe with our treatment, but unfortunately, it's 15 treatments over a year, so it's a big ask in terms of the number of trips that you would have to make. We do see people travel from areas that it's not available, but typically we then get the product into those areas if we find somewhere that we can find a patient and we build a business. Literally, that's how we've grown organically at the very beginning, being successful. We did have for a time an IND at Duke University, and we treated 20 patients, but that was to do with a drug shortage.
Post FDA approval, what's your go-to-market strategy in the US?
If we don't get acquired, we could set up a direct business. We've taken a direct business model. Actually, the CEO of CG Oncology, the company that I told listed for 1.8 billion, he helped actually build out our direct to market model. So we've got advice from somebody who's actually now a competitor, potentially my old boss as well, who was the COO of companies like Teleflex, and he's got a successful track record. He could lead us. He said he might have it might be convenient to work out in terms of time for him to take it. Or we could look at a licensing deal because there are lots of options. We've got it's almost infinite in terms of the options we've got, because with clinical evidence you get in the guidelines, it's unethical not to use you, and we're going to be able to determine our own J code. And so we're going to be really in control of the rollout, and we don't have to worry about high prices, because even at a very low price, we would still be making 85% margin in the US. So we're really in a very strong position.
And the last question is, how do physicians view this technology? Is it a major change to their process? Is it fitting right in with their current workflow? What's the situation with the current physician uses in this in the US?
So, I mean, we've tried it in 20 patients in the US and Duke. It fits in exactly with in existing processes. So what you do is you go to an outpatient setting, you'd be catheterized, they put the chemotherapy in there. In America, you'd lie on the bed, you roll over for an hour, and afterwards, then they take out the chemotherapy and you go home. So what we do is you attach to our machine. It takes 5 more minutes to set up our machine. Our machine runs automatically by itself. And what I mean by that, if we actually then move to a European setting, which is slightly higher turnover, is that one nurse can actually operate 4 of our systems at any time. They have 4 beds next to each other, so it's not such a private, salubrious setting. And they set up the system and make it run, and then it will automatically start the treatment by itself, and it goes on to the second patient, then they go to the third patient, and go to the fourth patient. So it's very easy and intuitive to use, and that's one of the criteria in terms of, it's not just that we've got a smart technology, it's a smart system to use within the clinical setting.
Well, great. Well, that's our 15 minutes. Thanks for a great presentation. Thanks for great questions from the audience as well. We have a 15-minute short presentation on how to invest in life science startups. I'll put that up on the screen right now. And then afterwards, we'll move into breakout rooms. If you can see my screen now, let me know, and we'll kick off and carry forward with this. Let's see. Does that show up okay, guys? Great. So we have a lot of investors that are interested in investing in the life science space, but they're new to it. They come from the tech or consumer product good background, and they're sometimes confused or concerned about some of the terminology, and they're trying to figure out what exactly are we doing in this space that is sometimes unfamiliar to them. And so we'll talk about that here in this presentation. So first thing to know about life science is that the returns can be spectacular here. It is just a fantastic return in many cases because the value brings so much money to it. Next is healthcare never goes out of style. Even in down markets, life science still continues on because healthcare still continues on. There's tremendous government grants that subsidize the technology development. Not everything has to be borne by the local investor for sure. And it's one of the best impact investments you can make. It's just taking better care of people. So there's lots of reasons to do it. The 2 categories we'll talk about today are medical devices and therapeutics. And medical devices are used to diagnose, treat, manage, or prevent disease or injury. And there are large medical device companies that exist, and for the most part, they do some innovation research themselves, but they also buy existing startups that are in the space that come up with novel and new technologies. Novel products offer bigger returns. Me Too products are much less. So if you're looking to invest, look for something new and different. There are three different kinds of patents out there in the medical device space. One is utility patent. This protects the technology enabling device function. There's the provisional patent. It's just simply a smaller version of the patent that gives you a year in which to make a decision if you want to go and build a future or full patent out of it. But it is less costly and it gets you first place in line in case you have a real winner there. And finally, there's design patents that protect certain aesthetics and aspects of the deal of the patent itself. Utility patent is the one that is the richest, and the thing you always want to figure out is what was filed and when talking to a life science company, just to know where they are in the process. So the key questions you want to ask a medical startup is, number one, reimbursement. What kind of reimbursement is available to it? And because the more reimbursement, the more people will use the product and the more money that comes into the process. Second is revenue. Is the startup generating revenue now? If not, when will it start? In general, the FDA paths are shorter for medical devices, and so in many cases, most companies are actually building the product and running the business for 3 to 5 years before they sell. So it's often the case that they will go into revenue. It's often the case in therapeutics that they do not. They sell upon approval, if not earlier. Next question you want to ask a medical device company: is their traction increasing? Is their profitability increasing? Which way is this going? Next, you want to look at physician friendly. Is this something that's easy for the physician to use? Is it set up in such a way that the physician can make money with it? And if it's physician friendly, it'll gain a lot more traction than if it is not. And finally, the market. How big is the market and how fast is it growing are key questions to ask. As I said before, if you want to invest in medical device, number one, look for an innovator, not a follower. Number two, look for peer reviews, especially from physicians and other KOLs or key opinion leaders that are out there, because you really want to know that others in the industry are tracking along with it. And next is you want to know the life cycle of medical devices. You want to know where we are with the new technology. Are we just beginning? Is it maturing? Or is it aging out? Just so you know what phase you happen to be in. So if you're a medtech investor, focus on scalable technologies that address unmet needs in large markets. So it's a large market, scalable, and no one's doing much with it right now. Those are the key three things you look for. You also want to look for interesting companies that can help reduce the overall cost of healthcare. The key here is you're not just shifting the cost somewhere else, you're actually reducing the cost. If you can do that, you'll find a welcome audience from the hospitals and the physicians. And next is you want to look at, is there a preference for, there is a preference for efficient, forward-looking companies. Again, if the innovation and the novel technology is reducing costs and reducing time, you'll find a ready audience for that company itself. There are alternative fundraising strategies for medtech, and even if they are raising money from angels or VCs or family offices, such as those in our network, you want to see if they're looking at other avenues, such as IPOs or SPACs. Many companies go IPO because they are needing a huge amount of money, and they just need a bigger market from which to draw it from. There's also the build to buy model. That involves finding a strategic company and building it for them under their spec, and then having them buy that from you. If not the whole technology, they're getting a license of the technology. We call those anchor clients, and they can be very helpful. And finally, you want to look for things like family offices. They're unlike VCs, they're not tied to the 10-year fund model. They can be much more patient capital. In many cases, they can offer more than just funding as well. So those are some things to consider. So here's your medical device checklist. If you're interested in this, we'll mail it to everybody afterwards so you have a copy of it. Is the patent secured already? Is the technology applicable to a specific clinical need where you can actually see it used? And is it an unmet need that's out there that people have not found a solution for? And also, can the technology be manufactured? Is it just a really cool idea that can only be made at one at a time? So you look for scalability in the manufacturing. You look for a design in such a way that is going to be scalable as well. And does the CEO know the space? Those are some of the key ones that we look at. Next is, let's talk about life science investing in biotech therapeutics, we have biotech platforms. Some of the key technologies we see today are cell therapy. They're transplantation of living cells into a patient to repair or damaged cells, and we see a lot of it in regenerative medicine. Precision medicine, this is where the medical treatment is tailor-made for your specific body or your genetic environment. Next is next generation gene therapies. A lot of gene editing and CRISPR technologies are being used to modify genes to achieve a certain outcome. And finally, there's machine learning enabled drug discovery. People are starting to bring AI into this to create drug discovery systems out of their technology, which can identify new targets based on some theory of solution. And that changes the business model as well, because you can actually license out those targets to others to make money. But there are risks in biotech investing. Number one, clinical failure. 64% of all therapies fail in clinical 3. So this is a challenge for the industry. Next is regulatory. You must get approval from the FDA, even if the drug successfully completes clinical trials. There may be other reasons why it doesn't all the way go forward. And next is market development. FDA approval marks a significant milestone, but you have to then ensure that the healthcare providers, the hospitals, and the physicians are buying into the technology. And finally, patent expiry. Patents don't last forever. When the patents go off, the competition will come in. Here's a checklist for the due diligence for therapeutics. Do they have lab data and mouse tests? Do they have chemistry, manufacturing, and control support? Are these tailored to specific biotech challenges, or are they general solutions? You also want to think about tax guidance for credits. There's also financial and operational optimization. Valuation is a big issue. How do you value it based on the value that it could have in the future versus what it has today? And then there's also ESG strategy and SEC compliance. So there's a number of key things to think about in the therapeutic space itself. When you get into the FDA world, you'll hear two terms. On the medical device side, you'll hear the PMA, and that's pre-market approval. That's what the device maker wants to achieve. And then on the therapeutic side, you see the IND. This is an investigational new drug. And that's what a therapeutic is trying to do, is achieve an IND standard with the FDA. So PMA and IND are key targets to figure out what they're going for and how far they are from it and what they have to do to achieve it. This often comes out in the form of milestones and fundraised tranches. In the medical device world, there's different types of medical devices. They're very low risk ones, class 1 they call it, like a thermometer. In some cases, those are exempt. There is no FDA. Then there's class 2 devices where there may be a glucose monitor, where it's a smaller thing, but they call it a 510K solution, where you have to get a 510K approval. These are about 6 months long to get in most cases. Then there are class 3, where they may be implantables and so forth, where you do need a PMA to actually go through to get approval. And then there are several alternative paths, humanitarian, de novo, and others that you may hear about. But like I say, these are the steps you have to go through for a medical device approval, and it's about 180 days on average. On the therapeutics, it's much more complicated. There's different pathways: standard, orphan designation, fast track, accelerated approval, priority review. And these just have different levels of phases and speeds at which you can do things to go through on the FDA. So these are the questions you always want to ask: is what FDA pathway are you on, and how far have you gone into it, just to know what's in front of you. Reimbursement is one of the biggest questions to ask. You always want to know, do they have reimbursements? You can either take existing codes and join those. Those are easy. Or you can create new codes, but it takes longer, but you could potentially generate more reimbursement for your product itself. So here's another checklist of key criteria to check. Market potential, is this a very big market? And pipeline, is this a platform or is it a product? I find many products are actually platforms, and if you position it as a platform, you'll get more credit for it. It's worth more to the one that buys it because they can apply it to more applications. It's a larger market. Milestones, you'll see many of the clinical presentations are broken down into milestones, and you want to look at the milestones to see if they figured out what is the path from here to FDA approval, and do they have the milestones figured out and the funding that applies to it. Cash burn is a big issue. These technologies are quite expensive to develop, so you need to know if you have access to cash to get all the way there. Team is the important thing to look for. Is the team been there and done that? Do they really know what they're doing? That makes all the difference in the world. And then there's IP as well. If you have any questions about this, love to share with you more. Love to talk with you about this offline. Let's set up a time to talk, and we'll share the slides in our follow-up to you guys. But with that, let's go ahead and move into breakout rooms. I'll pass it back over to Kat, and if anybody has any questions, love to talk to you in the breakout room. I'll have one, and each of the companies here will have one as well. So with that, let's go ahead and have you guys jump into the breakout rooms. And for those who have been here, we'll see you next time as well.